The Federal Reserve has just handed you an opportunity that hasn't been seen in nearly 2 decades. At the last FOMC meeting, 3 Fed officials voted to raise interest rates. But Beth Hammack, Neil Kashkari and Laurie Logan were all outvoted on a 9-3 decision to hold rates at 3.5 to 3.75%. Now, many are interpreting that as the central bank being stubborn, refusing to help the economy with lower rates. But that stubbornness is the reason a US government bond now pays you more above inflation than at any point since before the global financial crisis. So today we break down why bonds are paying so much above inflation, what the numbers on the table actually are right now, and what could close this window before most people even notice it opened. My name is Guy, and this is the Finance Bureau. Now, let's start with the basic numbers. And a quick disclaimer here, these numbers are of course dynamic, but by and large, this is the picture we're faced with as I make this video. So the FDIC publishes a national average savings rate, and right now that number sits at 0.38% APY. Bankrate survey put the national average slightly higher at 0.62%. Meanwhile, the top nationally available high-yield savings accounts are advertising somewhere in the range of 4 to 4.4%. Betterment advertises up to 4.4%, though that's a temporary promotional boost, with the standing rate closer to 3.25 to 3.9%. Axos and Newtek both offer roughly 4.2%, and a cluster of others are sitting right on 4%. What's more, they all offer instant access to your money and up to $250,000 in federal deposit insurance. So, why is the average somewhere below 1%? Why so low? Well, the FDIC figure is dragged down by the enormous brick-and-mortar banks, many of which pay something close to 0.01% on a standard savings account. Those banks have sticky deposits and customers who opened an account back in 2011 and likely never looked at it again. They don't feel the pressure to compete intensely for your money because their existing customers have already demonstrated that they won't be moving theirs anytime soon. So, the institutions that spent 2 years explaining how expensive money had become somehow never got round to passing any of that on to depositors. Funny how that works, eh? But the huge difference between the average rate and what's available in easily accessible high-yield savings accounts forces us to ask a question about this market. Why did an entire generation of savers stop checking? Well, because for pretty much as long as they can remember, there was literally nothing worth moving to. In December 2008, the Federal Reserve took its policy rate to effectively 0, and it stayed pinned at 0 to 0.25% for the best part of 7 years. There was a brief normalization in 2018 and 2019 where the effective funds rate got up towards 2.4%. Then in 2020, it crashed straight back down to somewhere between 0.05 and 0.09%, and stayed there through 2021. But the policy rate is only half the story, because what actually matters to a saver is the real rate. That's the return you get after inflation has taken its cut, and the best measure of it is the yield on 10-year Treasury inflation-protected securities, or TIPS. Now, in the simplest terms, this is just a government bond whose principal adjusts with the consumer price index. Across 2012 and 2013, that real yield bottomed out somewhere around minus 0.6 to minus 0.7%. In late 2021, it hit an all-time record low of roughly minus 1 to minus 1.1%. So, holding safe government paper was guaranteed to shrink your purchasing power, and that was the official policy. And that's also what pushed everybody up the risk curve. We got to a stage where pension funds were hunting for yield in private credit, something that could have serious consequences down the line. But, well, that's a story for another video. Anyway, Retirees who wanted income ended up owning dividend equities they never signed up for, with all the drawdown risk that comes with them. Cash was punished deliberately for over a decade to force capital into riskier assets. But fast forward to today, and we have a very different story when it comes to yields. The 10-year TIPS yield today is 2.41%. That's the highest sustained real yield since October 2008. 18 years since the system last paid ordinary savers an inflation-beating return for taking essentially no risk, or at least as close as you can get to no risk. Now, as I'm sure you're well aware, keeping track of shifts across rates, inflation and credit takes a ton of time and effort. And that's why we write the Finance Bureau newsletter, to make it easier for you to navigate this madness. It's completely free, and every week we break down global markets and the money flows that move your portfolio. So just click the link in the description or scan this QR code on your screen to get started. Right, let's get back to the Fed, which cut interest rates 3 times in late 2025, in September, October and December, taking roughly 75 basis points off the policy rate. And then it stopped. January, March, April, June and July of 2026 were all holds. Now the reason was inflation, which reaccelerated hard through the spring, peaking at 4.2% in May on the back of the energy shock tied to the conflict with Iran, with Brent oil spiking above $125 a barrel. After the ceasefire, headline CPL fell 0.4% in a single month in June, the largest monthly drop since April 2020, pulling the annual rate down to roughly 3.5%. Core CPI came in flat month on month, taking the 12-month core rate to 2.6%, down from 2.9%. Core PCE, which is the gauge the Fed actually targets, cooled to about 3.3%. Chair Kevin Warsh has said there is, quote, no tolerance for persistently high inflation, and that one good month doesn't mean mission accomplished. He described his divided committee as a, quote, family fight. Now, before I get into some more numbers here, there's one basic yet important thing to understand about Fed rate cuts. When the Fed cuts rates, the interest you earn on short-term savings and government debt usually falls first. So, every rate I'm about to show you is still this high because the Fed stopped cutting. Which brings us to the basic rule behind all of this. The longer you agree to leave your money alone, the more interest you generally get paid. So let's look at the options. Shelf 1 is money you might need tomorrow. High yield savings around 4 to 4 and a bit %, instant access and federally insured. But the catch is that those same accounts were paying above 5% in early 2025. They drifted down after last year's cuts because the rate is variable and the bank can change it any morning it likes without asking you. Now, Shelf 2 is money you won't need for a year, Treasury bills. As of filming, the 1-month bill is roughly 3.77%, the 6-month around 3.98%, and the 1 year about 4.03%. Now, on the headline number, that looks barely different from Shelf 1, but there are 2 reasons why it isn't. First, the rate is locked for the term, so a Fed cut in September does absolutely nothing to what you've already bought. Second, interest on Treasury securities is fully taxable federally, but completely exempt from state and local income tax. So, if you live in California, New York, or New Jersey, that exemption is worth a considerable amount of money on top of the quoted yield. Okay, Shelf 3 is money you won't need for a few years, and that's the 2-year note at roughly 4.18%. This is where you need to be a bit more careful though, because you're locking in today's rate against a committee that currently contains 3 voters who want to hike and a chair who has thrown out forward guidance entirely. And then there's Shelf 4, the 30-year Treasury at around 5.17%, touching 5.21% after the dissent news broke, which is a 19-year high. It's the biggest number on the page by some distance. But be sure to ask yourself why the government is willing to pay you extra for that one specifically. Well, because you're promising 30 years. If inflation runs hot in year 4, you sit there watching that 5.2% turn into a real return of roughly nothing. And the only way out is selling into a market that has repriced things against you. The technical term for that risk is duration, and with a 30-year bond, it is hugely significant. As a rough rule, if market interest rates rise by 1 percentage point, the value of that bond can fall by around 15 to 18%. So, the highest yield on offer isn't automatically the best deal. You're being paid more because you're locking yourself in for much longer and taking much more price risk. And that's why, for most people, the better answer is usually to spread the money across a few different maturities. Now, based on what we've looked at so far, it might seem like a no-brainer to put money in these bonds. But let's consider the other side of the argument for a moment. Over $300 billion flowed into US fixed income ETFs in the first half of 2026, on pace to obliterate the 2025 full-year record of $434 billion. Industry trackers report positive flows in more than 95% of fixed income categories. Total US ETF inflows across everything hit roughly $1.3 trillion by midsummer, with $191 billion in July alone. That is, admittedly, starting to look like a bit of a crowded trade. And it's crowded into a market with 3.5% headline inflation and 3 Fed voters openly campaigning for a hike. Ask any bond analyst and they'll tell you, consensus positioning in bonds unwinds violently when the consensus is wrong. But there is some nuance to consider when it comes to that point of view. The money flowing into bonds right now is overwhelmingly buying Shelf 3 and Shelf 4 exposure through funds, and a bond fund never matures. It holds a constantly refreshed basket of bonds at the same target duration, so there's no maturity date when you simply get your full principal back. If yields rise and stay there, the drop in value remains reflected in the fund's price. On the other hand, an individual bill or note held to maturity works differently. The Treasury returns 100% of face value on the maturity date, regardless of what the market price did in between. So the interim volatility is a number on a screen and nothing more. So we're talking about two completely different animals here. Moving cash from a 0.38% savings account into a 6-month bill is not a crowded trade. On the contrary, it's just a sensible decision in most cases. So then, the only question left is, what will close this window? Well, I can't predict it, and indeed nobody can, but here are the 3 things to watch. The first is the Fed's September meeting. Market pricing on that has been wild, swinging from a roughly 33% probability of a hike to nearly 66% within the same fortnight. The second is core CPI at 2.6%, and more importantly, its direction, because if that keeps falling, the hawks lose their argument and the cutting likely resumes. Now, the third is political. President Trump has spoken repeatedly with Kevin Warsh since the latter took the Fed chair in May, and while the reporting suggests those calls cover the Iran fallout and forecasting rather than any explicit demands, many would argue it blurs the line badly. Trump's public line was, quote, "Kevin's fantastic, but he's got a board," end quote, while continuing to insist America should have the lowest rates in the world. Meanwhile, Fed Governor Lisa Cook is making her own public comments that the central bank is ready to hike. Bank of America's Brian Moynihan doesn't see inflation settling into the mid-2s until late 2027. And his firm is calling for 3 rate hikes this year. So, with that wide range of influential options and outlooks, it's important to remember that this stuff is priced by the day, not by the decade. If you're holding $20,000 in a typical high street savings account, paying 0.38%, that account earns you about $76 over a year. The same $20,000 on shelf 1 or shelf 2 at around 4.25 earns you somewhere near $850. That's a difference of roughly $770 a year for some trivial admin effort. Remember that nobody, except yours truly, is going to point this out to you. Certainly not your bank that has no incentive to, definitely not your brokerage that makes more when you're in something riskier, and the financial press has spent 18 years training everyone to believe that cash is where returns go to die. Because, to be fair, for 18 years, it was. That was true when the real yield was minus 1%. It's not true, though, when the real yield is well over 2%. So, the public may view a reluctance to cut as the Fed being tough on the economy. But in reality, it's almost the opposite. For the first time in 18 years, people are being paid to sit in safe assets instead of being pushed into risk just to earn a return. Well, that's about all we have time for today, folks, but what do you think? Is this a gift to savers after 18 lost years, or is the market telling you something about future inflation that the Fed doesn't want to publicly acknowledge? Let me know your thoughts in the comments down below. And if you want to understand why inflation re-accelerated in the first place and what that energy shock did to the entire policy path, then you can check out our video on that right over here. As always, thank you so much for watching, and I'll see you in the next one. This is Guy, signing off.